I believe there is no perfect investment for everyone, but there can be a perfect investment for you at that point in time. The goal isn't to seek forever and not make a decision and find the best deal that you have in your network right there at the time within the time frame and make the decision.
Welcome to the American Dream Builder and Investor podcast, where our vision is to inspire busy professionals, especially first and second generation immigrants and Americans, to explore the state of the American dream in 2022 and beyond. That is the Trinity of Freedom: time, financial, and geography freedom. I'm your host, Micy Liu, and I have achieved financial independence, and I'm helping many others to do the same. I started out with $5,000 and have really built wealth for my family along the process. Now, I am on a mission to help hundreds of thousands of people like me to do the same.
Hi there. Welcome to another episode of the American Dream Builder and Investor podcast. This is our part 3 of our due diligence sessions, where we'll be learning about some of the due diligence questions I tend to ask on current property performance and projections. Well, as always, I'm not a financial advisor, not auditor, and I'm just giving you a list of questions I typically would ask that we usually see when we're evaluating opportunity. So if you look at the entire opportunity at a high level, it's really about giving you risk-adjusted returns, and the returns typically in 3 forms I mentioned in previous episodes. That is your cash flows, which is essentially the amount of money that's left over to distribute to investors after we collect rent or other income, deduct our expenses, pay out debt services and other fees, and the money that's left over to distribute to our investors, whether that's on a quarterly basis or monthly basis. Now, the second piece is appreciation when we sell, whether that's appreciation based on the market because the market is so hot, or appreciation that we're forced onto the property by doing value add-on to the properties, such as improving the kitchen, upgrading the kitchen, the bathrooms, putting out VP floorings and putting a new paint, etc. That makes people want to pay more to live in the property, therefore paying higher rent and therefore giving us more rental income. And at the same time, keeping the expenses the same or improving the expenses, it gives us higher net operating income. And even the market cap rate is the same or even reduced or even went up, we can still sell for more. So that's when we actually have an appreciation return on the property. And the third piece is the tax benefits, which we'll talk more about in one of the next episodes. But those are the 3 important pieces. So when we look at those, the tax benefits is usually pretty straightforward. It's basically when we do a cost segregation with a cost segregation company that's has cost segregation engineers and CPAs. They tell us, well, how much we can deduct for you as a passive loss for the first year of your investment of $100,000 or $50,000. That's basically what it is. There's not much we can do it apart from just having that passive loss to you as the company, the expert instructed. But when it comes to the other 2 pieces, the cash flow and the appreciation, here are some numbers you want to make sure you understand. I'm going to go through some of the typical questions, and then I'll do another episode on some of the lessons I learned that wasn't really taught to me, but it was more as I learned throughout the different deals and by looking at more deals. But anyways, on the ones that's a little bit more typical questions to ask is really trying to understand those 2 pieces, as I mentioned. But as you may have heard, even on those 2 pieces, there's a few things that's really changing things a lot. So what's changing our cash flow or our returns are income, expenses, debt services, meaning mortgages, and fees from a sponsor standpoint, and what's happening in the market in terms of cap rate for this type of specific asset in this market. So we want to understand basically why the numbers on those areas are what they say they are. Why is the rent like this? Why are you saying the rent is $100 more after you renovate versus now? What's your basis point for coming up with those numbers? How are you able to reduce your expenses when you have changed the property management company doing this and this and this? how are you able to reduce your taxes if taxes are going to be reassessed next year at a higher value? So asking those questions, and ideally those information should have been provided to you in their slides or their Excel file, where it talks about each year what the rent and what the income and what the expenses should be. So I wouldn't say question everything, but use eagle's eye to look at those numbers and try to understand why. If there's any numbers that's really driving a lot of the returns, from whether it's a huge increase in rental income for the first year or a huge increase in rental income in the next few years, understand why. Or huge decreases in expenses, understand why. So that's really it, because at the end of the day, we don't want to ask all 110 questions I have on my website. We want to ask the ones that drives the most impact, drives the most amount of returns potentially. And some of those income is, from an income standpoint, the most amount of income will likely come from your rental. But you can also have some of the RUBS income, which stands for Ratio Utility Billing System. It's a method of calculating the residence utility based on occupancy, apartment square footage, number of beds, and some combination of factors. Well, they're just paid typically more of a standard fees for the utilities. And you may also have laundry income. You may also have billboard income if you have a lot that you can put billboard for advertisement. You may have self-storage income if you have extra spaces that you can rent out. So there could be many different ways you can get income, but usually the rental income is the majority amount. Also, you can find ways to reduce expenses by finding better contractors, cheaper contractors, by writing the leases differently, right? For example, you can engineer the leases differently to allow the tenant take care of certain maintenance responsibilities, therefore reducing your expenses. So those are the things you can take into consideration of to see which ones to increase, which one to decrease. Another thing is debt services and cap rate. In terms of debt services, right, which we'll talk a little bit more about this as well. We want to understand, is the loan being assumed or is it going to be a new loan? That's going to change how difficult it is to close on the loan sometimes, because sometimes loan assumptions are a lot more difficult. Is it non-recourse loan or recourse loan? Non-recourse is different from recourse. A recourse debt holds the borrower personally liable, and all the other debt is usually considered non-recourse. So a recourse debt, like home, credit cards, etc., allows lenders to collect what is owed for debt even after they've taken the collateral. So it's more of a preference. Usually for sponsors, they want to take the non-recourse loan just because it does provide a layer of protection for them, because nothing is 100% guaranteed. But for some people who are passive investors, they feel better if there is a recourse loan, because that person who signs their name on the loan is held personally liable. So they feel like there's another layer of interest for them to work really hard for the money that the passive investors put in there. And sometimes with a recourse loan, you're able to get a better rate because it is recourse. So there's different factors, pros and cons with that approach. You just want to make sure you're aware of it, understand how that plays into the risk factor for your investment.
This podcast is sponsored by Life Mission Capital, founded by me, Micy Liu, where my life mission is to help busy professionals invest well so they can focus on what matters. All my life, I was taught to study and work hard for my freedom, until one day I realized that unless I let my money work hard for me, I will always be trading my most precious resource, time, for freedom. Since then, we have also been helping our investors passively diversify into more than 1,000 units of recession and inflation-resistant alternative investments, such as multifamily, mobile home parks, short-term rentals, and more. Learn more with our free ebooks at lifemissioncapital.com.
You also want to understand the interest rate. Is it fixed? Is it variable? If it is variable, how it's changing. Is it based on primary or what else it's based on? And is it only for 3 years and you can extend it for another 2 years? What are the conditions for extending for those 2 years? How likely it is that they may reject the extensions? So those are the things you want to learn about as well. And is it a bridge debt? Are you able to do draws on the funds, or do they give it to you all at once? And how is the debt structured? Is there preferred equity in a deal that would be senior to your investment. So, if you ever purchased a home of your own, typically the debt piece is very straightforward. You put your 20% or however many percent down and you take out a loan. But in real estate syndications, the debt could be a lot more complex. So you still have the loan you have to take out. Let's say for $100 million, they give you 80% loan to value, which is very hard to find in today's market as of January 2023. But just for the simplicity of the example, let's say for $100 million of purchase price, we can give you $80 million. That gives you the need to bring $20 million to the table just to close on that. Let's say you need another $2 million of capital expenditure budget that you can't finance through this loan. So that's $30 million you need to bring. But sometimes for certain people, rather than bring all those $30 million in regular equities as investors, they would do what we call preferred equity that sits on top of the regular equity investors. They may say, we're going to pay you 11% per year, and we're going to make sure we pay out debt services to the mortgage companies, then we pay the preferred lenders first, and before we pay our common equity shareholders. So typically there's nothing wrong with that until there's a problem and until the property is struggling and your interest comes last. So that's something you need to be aware of. A lot of times deals may not go bad until it goes bad. And we mentioned a little bit earlier about the loan to value. That's also important. The more leveraged you are, the higher the debt payment, and the more you have to come up to pay. So it's more leveraged, more risk. So right now, as of January 2023, we even see deals that's 60% leverage, 50% leverage, in some cases all cash, just to close and reduce the risks involved in having to make the payment or go through such high interest loans, or not getting to the closing table because so much back and forth with the lender or the changing interest rate. So you also want to understand what's the duration of the loan. Is there any prepayment penalties? As you know, loans is also an investment for some people, right? The banks are loaning it out, so they want to get certain returns on that amount of money. So if you pay back too soon because you're trying to sell it, they want to make sure they're still gaining some type of returns. So they usually have a prepayment penalty within a certain amount of time. So you just want to understand that different length of the loan can have different amount of prepayment penalty at different times as well. And another thing about the loan is not just the loan you have now, but if you're having a bridge loan, do you intend to refinance? Is that a plan that it has to happen for the entire project to work, or is it an optional refinance? Think about that, because we always want to be flexible in real estate. Real estate is a very illiquid investment. So the more exit strategies we can provide to it, the more we have control of our money, of our liquidity. So we need to think about, what's our exit strategy? Do I refinance? Do I not refinance? Do I have to refinance? So other things to think about is, if we do refinance, what is the interest reward going to have? We talked about cap rate upon selling, but when it comes to refinance, the cap rate isn't really as big of a factor. It's really about what the lender thinks they can lend to you up to a maximum, and that how much they can lend to you depending on your ability to pay, right? The debt service coverage ratio. What's the ratio you're able to cover the debt on? And that's going to depend on how much the interest there is, how much you're able to take out as a percentage to the value during the time of the refinance. So I know I'm throwing a lot of numbers at you, but think about all those numbers. They all tie up together. That's what I love about real estate, right? There's only so much money coming in, so much money going out. And you can tie out the numbers, play different scenarios, run sensitivity analysis, suggesting when rental income goes up or down, occupancy goes up or down, cap rate goes up or down, how will that affect your investment? Even though we can't know anything for certain, but we can say with certain degrees of confidence that our returns will likely be between this and this number. And that's what gives me comfort when I run through the numbers on the debt piece, when I run through the numbers on the property, and on the jockey, which is the sponsor we talked about, the market. So all those are really just inputs before you gather all these inputs and put them to this model, which are kind of represented by some of the questions I'm going over with you. And they have this output, a likelihood of how much you'll be able to gain from this investment. And you bump that against what the sponsors are advertising, I think you'll come up with a pretty good idea of if this is a good investment for you. As always, I believe there is no perfect investment for everyone, but there can be a perfect investment for you at that point in time. The goal isn't to seek forever and not make a decision, but to understand what you need, what you're looking for, cash flow, appreciation, and tax benefits, and find the best deal that you have in your network right there at the time within the time frame and make the decision. The thing is, the deals are going to come and go. The market's going to change. I believe strongly in buy real estate and wait. You don't have to put all your eggs in one basket at one point in time across one particular asset class, but continue to accumulate. That's what really helps passive investors to grow and protect their wealth. Continue real estate syndication opportunities, your own properties, and just to continue to accumulate, buy real estate and wait. So hopefully that's helpful in part 3 of the due diligence series that we're going through. Now, going to our next episode, we'll cover our last piece, the deal structure. Hope to see you there soon.
Thank you so much for tuning in to the American Dream Builder and Investor podcast with me, Micy Liu. We hope you enjoy the tips and tricks that others have used to build their American dream and their trinity of freedom. We would love for you to subscribe and leave a rating and a review. You can also find all the episodes and details on lifemissioncapital.com. Until then, let your life mission go wild.